Thank you very much, Chris. It's a pleasure to be here. Hello, everyone. My name is Troy Donahue. I head up America's portfolio trading at BTIG. In that role, I help institutional investors to implement their various institutions and investments and help grow their products. We work closely with ETF sponsors on a daily basis. So today we'll be talking about active management. We'll talk about the benefits the active wrapper has over its passive counterparts. We'll talk about the blistering growth that we've seen over the last 5 years. And we'll talk about why sponsors continue to be laser focused on bringing new innovative products to the market. On this panel, we have 4 individuals who are all experts in their own fields. They'll help tell the story today. So I'll allow them to introduce themselves. We'll get started with Jonathan here.
Yep. Yes, Jonathan Dale, Head of Product Solutions at Westwood. I've been with Westwood for about 10 years, wearing various hats, national accounts, product, working with our sales team. Prior to that, I did 15 years at SEI, helping boutique managers bring products out to market, particularly ETFs, Crane Shares, Global X, and my ETF fun fact is that I was one of the original iShares call center reps back in 2000, so my days go back 25 years.
Hi, I'm Tim Coyne. I'm head of ETFs at T. Rowe Price. I joined the firm in 2019. My ETF career goes back to 2000 as well. I started at the American Stock Exchange, which was the home of ETFs. But yeah, it's been really exciting to see the explosive growth of ETFs and just how this market has evolved, both across passive, active, equity, fixed income, international, et cetera. I look forward to a great panel.
Hi there, I'm Matt Schwark. Thank you, Troy, and thank you to the Expert Series team for having us here today. Again, I'm Matt Schwark. I lead broker-dealer strategy for State Street Investment Management. As of this morning, we have 175 ETFs in the U.S. marketplace. We debuted our first ETF in 1993 with the launch of SPY. Approximately 20 years later, we launched our first active strategy in 2013.
Hi, my name is Jay Hatfield. I'm the CEO and founder of Infrastructure Capital. And we have $3 billion under management. We have 7 ETFs, 6 of which are active. 4 of our ETFs are on the fixed income side. And we'll talk about it later, but that's particularly critical to have active management. And the other 3 are on the equity income side. All of our funds yield between 6 and 9%.
Great. So I think it's always helpful before we get going just to give a little context on where we stand and what we'll be talking about today. So the first active ETF was launched in 2008. Does anyone know who launched that ETF? That is correct. So very interesting point. So fast forward to today, we have over 2,500 different actively managed ETF products. It's been a perfect storm of growth for 3 key reasons. The first is a favorable regulatory landscape, which has helped issuers launch these funds. We'll talk about that. Second is investor demand for differentiated products for both alpha generation, but also risk management. And then third is sponsors' adoption of more tax-efficient structures like we see in the ETF. This is the 4th year in a row that I've hosted this panel, and I'm always blown away by the growth that we see in the actively managed ETF space. When I first did it in 2022, there was a little over 1,000 actively managed ETFs. AUM was about $330 billion. So to put that into context, Matt talked about SPY being the first ETF around. That has double the amount of assets that the $330 billion we saw in active in 2022. So think about that. One product was double the size of 1,000 different actively managed products. Today, we sit at $1.4 trillion in the active space. And 2025 has been an inflection point because there's now more actively managed ETFs than passively managed ETFs. Because of that growth, BlackRock thinks that active ETF assets will be at 4.2 trillion by 2030. That would be 16% of the actual ETF assets compared to just 8% today. This is the panel you want to be at. This is where the growth is. This is where the innovation is. This is the right room to be in right now. So we'll get it kicked off with Jonathan. You can't talk about active management without Rule 6011. So that was a big catalyst for actively managed ETFs. Can you talk about the benefits of what's commonly known as the ETF rule and how it positively affected actively managed funds, and more specifically, Westwood?
Yep, yeah, absolutely. Thanks, Troy. So 6011 back in 2019, really, there's really three main points that came out of that SEC ruling. The first one was really speed to market. It created a regulatory framework where you didn't have to get exemptive relief orders for every single ETF that was in filing. Prior to that, it was a very slow process, and so that helped speed up the opportunity for managers to come in. Second was transparency, so daily holdings out on your website, bid-ask spread information on a daily basis, and as well as premium discount, daily and historical data. Those three things opened up an opportunity for, or those two things opened up an opportunity for managers to put their strategies out to market. But the third key point of 6011 was custom baskets, right? So taking advantage of market inefficiencies, active managers coming into the space and being able to use the ETF structure for tax management, portfolio management. These 3 points really helped active managers come into the space, but I think it was really 2020 with the derivative rule of 18F4, when you married 6011 with 18F4, where the derivative rule gave a regulatory framework for use of derivatives in portfolios. This is when things went off to the races. There was a couple strategies out prior to 2019 in the defined outcome buffer product sets, but when you have a nice regulatory environment, you have a framework for use of various tools to bring active strategies out to the market, we were kind of off to the races at that point. Yeah, you saw a lot of managers bring out income-based strategies. Westwood in 2024 brought out 2 income-oriented strategies with our energy suite. We acquired a firm based in Houston, Sailing Partners, back in 2023, who had desires to do ETFs. Once they came over to Westwood, we gave them a platform to bring out 2 covered call ETFs that are higher yielding, that use calls and option strategies on something that already was a higher yielding profile with the energy products. And so it really was the 6011 and the derivative rule that gave us that opportunity.
Yeah, and it's clear that many sponsors took advantage of that to launch actively managed ETFs because it leveled the playing field. Tim, T. Rowe's entire ETF suite is actively managed. It's clear you see that as a competitive advantage. What advantages does that active structure give, and how do you use that to make differentiated products at T. Rowe?
Yeah, for us, active ETFs were kind of the natural next step for the firm. So as a firm, we manage $1.7 trillion globally. And that's really based, over the last 85 years, has really been based on the strong fundamental research platform at T. Rowe Price, the ability to risk manage, and then independent thinking that goes into our selection. For us, we now have 20 products in market. As Jonathan mentioned, we launched our first product back in 2020, largely due to the fact that for regulatory changes that occurred in 2019. But we also, we first filed for ETFs 12 years ago, so well in advance of our actually listing. So again, we thought this was, and also just listening to our clients, right? Like we were hearing consistently from our clients a growing preference for ETFs as a structure. And even some of the long-standing mutual funds that we've had, we've now offered in an ETF. That was kind of our first generation product set. Our first 5 equity products were based off of existing mutual funds. But also, and I'll talk later in the discussion, I think, about like what are some of the macro drivers of active ETFs and the growth that we're seeing. But I also think, the rise of active ETFs is also, what is being delivered, right? The ability to generate alpha, to pursue outcomes in a risk-managed way. And then I think when you look at passive in terms of like the way that we've built our product suite was kind of first started with core, good standalone products that also fit into multi-asset solutions and model portfolios, et cetera. Then kind of the next circle out, thinking about thematics and sectors, then thinking about more client outcome type products. And now we're kind of in an innovative stage where we just filed for the first actively managed multi-token cryptocurrency product. So we're really excited about that. But if you look at, sectors is a good example. If you look at the GICS compilation and index, it's very rigid. And two of the largest tech funds out there on the passive side have heavy concentration, where 3 stocks represent about 40% of the overall index. So we think that leads to concentration risk, but also limits the ability to invest kind of across sector, across industry, or across region. And that's where, we launched a tech active T-Tech, TTEQ last year, which does give us the ability to basically generate alpha, pursue other opportunities beyond just the index. And as an example of that, in October of last year, we purchased OpenAI in the portfolio, something that an index portfolio can't do. So I think, taking a step back, looking at the macro level, most advisors, industry data that I've seen, it's like 75 to 80% of advisors are using both active and passive strategies. So I think the combination of, the fundamental research that we do, coupled with the benefits of the active ETF structure and what that delivers to clients is a really compelling offering.
That's a great overview. Matt, State Street's approach is a little bit different when you look at active management, because you team up with different partners who are the experts in their respective spaces. Blackstone, Galaxy Digital, Double Line are a few that we've seen. How do these partnerships come about, and why have they been so successful?
Sure. Thanks, Troy. Great question. As mentioned earlier, we have 175 ETFs in the marketplace. 48 of those are active strategies, and 12 of those funds are managed by an external investment manager. So our approach to active management is, if we don't have the in-house capabilities to provide superior performance, we will look to an external investment manager to partner with. So these partnerships come about in 2 separate ways. The first is, we do a lot of internal analysis, and if we identify a gap in our lineup, or if we have a passive strategy that we feel could be better offered in an active form, we look to partner with somebody who can help bring that strategy to market. The second way that these partnerships form are through reverse inquiry. So Troy mentioned several of the sub-advisors that we currently work with. We have 6 that we work with. A lot of times we will get reverse inquiry from those 6 that we already partner with, looking to launch additional funds, or we get inquiries from advisors who we are not partnering with, looking to launch an ETF. The latter is beneficial to the advisors looking to launch, because they can use our platform without having to do all of the legwork to get their strategy to market. So some of the considerations that we take into account when looking to partner include investment capability and performance. So has this advisor demonstrated a proven track record? Are they a well-known brand? And is there opportunity to scale the relationship? So we may launch one product here in the US, but our ultimate goal is to launch more than one product here or in other regions of the world. So EMEA, APAC, we look for true global partnerships. After we identify these partners, we go through the vetting process. For advisors who are already 40 Act advisors, that process is quite a bit quicker and can take as little as 3 months. for advisors who don't have a 40 Act wrapper in place, the process can take a bit longer, approximately 18 months or so. In the success of these partnerships, is based on the fact that we recognize that we are not best in class in everything, far from it. So we look to partners who can help get the best product in market on specific strategies.
Yeah, and that seems like that multifaceted approach allows you to extend your offering to areas where you might not be the best
Absolutely.
in class, like you said. And it's proven to be successful. Jay, infrastructure capital invests in securities that are typically backed by assets. Can you talk about the approach that you use as a firm and how the active ETF structure allows you flexibility for developing your products?
Yeah, so in terms of talking about active, you really have to divide it between fixed income and equities. And when it comes to infrastructure, we're much more focused on the fixed income side on infrastructure. So if you lend money, it's always fantastic to have real collateral. So if you look at our flagship fund, PFFA, we have very heavy concentrations in pipelines, things that I used to be a energy investment banker, pipelines, utilities, REITs, companies where you can analyze every asset one by one. But the other great thing about preferreds and why PFFA is our flagship fund is it's 70% indexed, and it's so easy to clobber the index, like clobber with a capital C. So right now is a perfect example. So the index funds horribly have 10%, up to 10% in MicroStrategy preferreds, which is a really, really bad idea, at least in our models. We like this thing called cash flow when we lend, not speculative gambling like Bitcoin. Great if you're an equity investor. It might go to $1 million like everybody thinks, but we're credit investors. We want real assets that we can actually sell. So we're not in those at all. We occasionally buy them and then sell them to index funds really rapidly. And so we are like doubling the returns of the index funds, and there's 4 or 5 other ways we can easily do that. On the equity side, it's a little bit more challenging because sometimes the dumbest equities go up the most, like MicroStrategy being a good example of that. When it was trading at 180% of NAV, now it's 0-ish. So you could be an active management, not be a manager, and correctly not be in MicroStrategy. But what we do is we do use cash flow GARP models like you would in a hedge fund. I used to work in hedge funds. But we do what somebody else was discussing. We write covered calls. We do use low leverage. We'll buy preferred stocks. We'll put a little bit of credit. And then we focus on income securities, particularly more on the real asset side. So we have been able to add a lot of value on the equity side, but it's harder because, number one, like I said, indexes can do better at times because they have the momentum stocks in them. And you don't have this huge index component like you do on the preferred stock side.
Thank you very much. So we'll swing it back to Jonathan. We'll talk a little bit more about the structure. So as head of product solutions, what have you seen in the management of an ETF that's different than a mutual fund or even an SMA?
Sure. Yeah, so when we started getting into the space and trying to figure out what is the right way for Westwood to approach it, we went through an analysis of our mutual fund lineup and our SMA product set. And we're a 42-year-old firm, U.S. value, multi-asset. We mentioned the energy suite. We have tactical asset allocation strategies, and we say, well, what's the best way for us to enter the space? Do we want to do mutual fund conversion? Do we want to launch a new ETF? Do we want to do an SMA conversion? So we went through this full analysis of what is our best approach. And you look at the conversions, the process was going to be a bit too onerous and not necessarily get to where we want to be. Because on the other end of every decision is, do we have a good ETF for the marketplace? And so Conversions, we just didn't think would make a lot of sense. You know, you look at the U.S. value suite, you know, that's more of an area where in our market, more defined contribution, more institutional. You have capacity issues with small cap. You know, there's a lot of things you have to take into consideration. What makes, you know, what works. And you know, when we look at energy, we thought that was really the area that we could, you know, make a dent. There was a gap in the marketplace around diversified sources of income, so having the midstream MLP products that we had a lot of experience with, running calls on each one of them. Now you're in a much higher yielding profile, 10 to 12% for both of those, and that really looked good. But we went through this, you know, thought, well, maybe we'll convert some SMAs in the MLPs that we have over to it and get jump started that way. But then you look at go through the tax analysis, and you got K1s, you got all the individual investors, and going that deep in that, you know, owners of a, you know, tax, you know, not audit, but kind of review and making sure the paper trail, you know, stacks up. It was just too much. So we said, let's just bring these out to market, you know, as is. And we've been, those strategies have been very, you know, very successful. But as a manager, we're also saying, okay, we need to speed up our entry point into the ETF marketplace. And how do we do it? Do we have the capabilities? We do in some places. We have some products that are in registration that we think are going to be unique, but we wanted to jump in a little bit faster. So we did a joint venture with Webb's ETFs, who's a sponsor here today, where they have defined volatility ETFs, where, you know, going back to my original comments around 60/11 and derivatives, be able to get exposures to you know, underlying ETFs, SPY, QQQ, and the sectors, and be able to dial up and down exposures depending on realized volatility, and that uses swaps. So we really wanted to get into the marketplace as quickly as we can and as unique as we can to have you know, have a suite that we think is going to be successful. But you know, looking at those differences between, you know, mutual funds and SMAs and how we wanted to take advantage of them, every one of them has challenges. Every one of them has, you know, the mutual fund, you know, we want to give it a little more latitude around our ETFs versus what constraints are inside the prospectus, or and as I mentioned, you know, with SMAs, the project to get that to work was going to be, you know, might not have been worth it in the end.
Net, clearly there's a lot of decisions that go into what product you're going to launch, and the considerations that you have to think about will be best for the end investor. Tim, we've seen tremendous growth in the active ETF space. I talked about it a little bit earlier, but currently 8% of the assets are actively managed in the ETF space. That's up from 4% just 3 years ago. What are you hearing from clients, and why are they gravitating towards actively managed ETFs now?
Yeah, I think, you know, I talked a little bit about just kind of the growing preference for the ETF structure, generally speaking, and now that, you know, with the rise of active ETFs, I think it was a kind of a supply demand, right? The demand was there for high quality active. What was missing was the supply of products up until very recently, right? And if you look at the statistics, it is amazing, the amount of growth in terms of the number of products that have been launched. I think this year it's even like 85% of all ETFs at the industry level that have been launched are active ETFs. So basically, you've seen the market form over the last kind of 5 years in terms of exposures that are now available in the ETF wrapper. You know, you quoted there's more active ETFs than passive ETFs. I think the rise of model portfolios is another key driver, right? There's more ETFs now in model portfolios than there are mutual funds as of a couple years ago, right? And that train's not slowing down either. I think, generally speaking, when you look at, you know, over the last 5 years too, right, there's been a lot of market uncertainty between wars and tariffs and COVID, et cetera, so increased volatility. So more clients have been turning to active solutions to help navigate that market landscape. On the innovation side, you continue to see expansion of products, not just in kind of core equity fixed income buckets, but also, you know, think of derivative income. You know, I talked a little bit earlier about crypto, et cetera. So I think you're going to see a lot more different types of products that are developed and delivered through the active ETF structure. I think there's a lot of momentum now. Like a lot of products have built some track record, right? 3+ years track record. You see an increased velocity in trading volume. So all of the things that clients look at when they're making their decisions in terms of performance and exposure and how the product's behaving in market, et cetera, all of these products now have, or a lot of these products now have established track record. And I think, you know, I mentioned the range. The range continues to expand. And so, yeah, I think, quite frankly, like when I joined T. Rowe Price, you know, I was asked the question how big active ETFs could get. And my response was, I think they're going to change asset management. And that was back in 2019. So I think we're still really early stages in terms of like full adoption of active ETFs and where this market goes. So yeah, I'm really excited about that. And I think, again, we're just scratching the surface.
And I think that dovetails into what we want to talk about next is that innovation and what kind of products we're seeing. Jay alluded to it earlier that most actively managed products are fixed income or equity, but that's quickly changing now. So Matt, can you talk about what you're seeing at State Street and the products that you're excited about coming in the near future?
Yeah, sure, absolutely. So, quick backstory, I've been at State Street for approximately 8 years. The first 6 years of my time at State Street, I think we launched approximately 15 ETFs in aggregate, probably all passive. Over the past 12 months, we have launched over 40 products with 33 or 34 that are active strategies. Outside of our traditional equity or fixed income, we have launched products in private credit. So we have 2 actively managed private credit funds. We've launched 2 actively managed bond ladder suites, a muni suite and a corporate suite. We partnered with Galaxy to launch 3 actively managed thematic ETFs that focus on the digital asset space. We launched a product with Bridgewater in Q1 of this year, essentially putting their all-weather strategy into an ETF wrapper. We took our sector funds, the 11 GIC sectors, and launched in July a suite with an embedded option for an enhanced income. So, you know, we recognize the pace that the industry is growing. We're trying to participate in as many ways as possible. Again, we've launched, you know, multiples of the products that we did in my first number of years at State Street, and we're not slowing down anytime soon. We have some interesting stuff that is not yet filed for, but we're always looking to identify new opportunities, new innovative ways to launch ETFs.
That's great. And we'll keep it on the innovation, moving over to Jay. As CEO, you probably see a number of great ideas that come in. Can you talk about where you think the next leg of innovation will be and how infrastructure capital can capitalize on that shift?
Well, most of the ideas that come in are inside my brain, so we don't really take the calls from the outside like State Street does. But what we look for, though, we being mostly me, but our team, is really where there's huge passive assets that are doing a horrible job. So I already mentioned fixed income. You definitely, particularly on the preferred side, but also high yield bonds, they're callable. They have interest rate risk. They have credit risk. You cannot ignore any of those risks. With equities, like I mentioned before, sure you can. You're like, oh, MicroStrategy, it's fantastic. Well, you know, it doesn't matter that it's really stupid. It goes up and up and up. But when there's an actual call feature, it can't go to infinity. So very easy. So we're launching 3 new fixed income products on the preferred side because we have a huge advantage there, and we're arguably have the top performing fund over the last 7 years since we launched PFFA. But also on the equity side, what's really, really bad are the index call writing funds. So not to pick on anyone, but you might know JEPI. They write the entire index. That's just a really bad idea. And a lot of the funds do that. One of the NASDAQ funds does that. We think it's a terrible strategy. Way better to pick the actual stocks you want to write calls on and not write the entire portfolio. Because you're going to have markets like we had this year where they just run and run and run and run and run, and then they come back off. You're going to massively underperform. But we use HI, so we have judgment on the market. We have great macro research as well, which you can access on our website. So if you apply those two things, we have historically been able to beat both on the equity side and more straightforward on the fixed income side.
Great. So in the last 15 years, at almost every single panel or conference, education has been important, and it still is important today. It's just the shifting of what you're talking about. So I think with active, investors need to get even more education because they think of it as maybe a little bit riskier of what can go wrong versus just a passive strategy. But oftentimes, these funds are used for risk mitigation. Can any of you talk about the educational side with clients and what challenges you have on pitching these active strategies?
I mean, I'm happy to start. I think generally speaking, education is always really important with respect to ETFs and investment management, generally speaking. But I would say that the first couple of years when we first launched, we sat with a lot of clients to kind of walk through the structure, how these products worked, what the expectations were. I think there was a lot of focus on kind of the trading and the trading aspects and how would these trade. Is there any difference between an active ETFs and any different considerations that I need to take into account in my execution strategy, et cetera. And at the end of the day, these products are ETFs, and they trade on exchange, and the liquidity provision and formation around these products works the same as any other products. And the vast majority of active ETFs are also transparent. So, not only can investors see what the holdings are, but on a day-to-day basis, there's files that go out to market makers that are actively, continuously making, two-sided quoted markets in these funds. So, but yeah, I think generally speaking, from my perspective, at T. Rowe Price, we have a really well-known brand, but we're not as well-known in the ETF space, right? And that's where we've really been focusing on, is connecting with clients and telling our story. I mentioned we have 20 products in market. We're going to launch over a dozen products this year. We have 80 different strategies in consideration in our product roadmap over the next several years. So we're going to be kind of, next year we'll probably another 12 or so type products. So I think the education, the awareness is growing and getting better, but definitely need to continue the conversation in the market.
Yeah, I think to add to that, going back, as I've said, going back 25 years in some of the original conversations we were having with index-based ETFs, right? That liquidity, it's really based off the underlying holdings. And so now we're bringing all these new active ETFs out to marketplace that with managers that may not have a lot of experience in ETF trading, right? And just even the basics of ETFs, creation redemption process, daily liquidity, educating the advisor, saying, okay, well, I have this new ETF, but I'm only seeing a couple thousand shares traded. I want to get best execution. How do I manage that? So we've been working with our sales teams to be able to have those conversations and be able to give confidence out to advisors that think that this is a good idea. I like to invest in it, but I want to make sure that there's staying power with these products over the long term. And so I feel like we're still in. It feels still like early days of education because of all the new managers coming into place and having to deal with these challenges that existed 25, 30 years ago.
Yeah, the education piece is certainly very important, and it'll continue to evolve as the products evolve. We've made a big shift to active management. Investors are becoming more comfortable with that, but the education piece is paramount to make sure that they know what they're investing in and feel comfortable with that. And that will drive the next leg of growth in this active space.
I would just add that from our perspective, we're a total disruptor, so we don't really try to convert people to ETFs. We look for advisors and individuals who already bought into ETFs, and that's most people at this point. But what we do have to spend a lot of time on, and we think it's an opportunity, is on the nuances of fixed income in particular. Preferred stocks are really hard for individuals to manage. They're hard for them to trade. It's hard to be diversified. And then all the nuances of how terrible the index funds are. They have to rebalance every month. They do it a very sloppy way. They are cap weighted, so they buy the stocks that go up, which is terrible when you're in fixed income. So it's more the details of the products than it is ETFs. They really already bought into the ETFs. And then the other nuance, which I referred to, is this notion of writing individual calls on stocks that are where you have a gain and where your models show they're fully valued, versus writing on the whole index where you can get run over by momentum like NVIDIA running up, and you don't have enough NVIDIA in the underlying stocks. So we're more focused on the nuances underneath the wrapper, and we try to preach to the choir to people who are already bought into buying ETFs.
If I could add just one thing, in addition to client education on all these new active strategies, it's of utmost importance that our sell-side partners and the liquidity providers are also comfortable, know exactly what's in the portfolio, and are comfortable with these strategies so that they can make good quality markets in the products. Because without good market quality, we all know it's difficult to sell any product.
Thank you. What are clients asking? Are you hearing differentiated questions now about the products? Is it about trying to outperform the market? Is it more about risk management? What are clients using active strategies for in their portfolios?
I guess I'll just kick off since I'm the last on the list. That really, the way we look at the business, since we're a full active manager, that our client service is beating the index. So, I'm anxious to get off this panel and go back to our office, not very far away, and start managing our products. So we spend 95% of our time building the product, AKA having great performance, and then they will come. So versus trying to convince them to buy something that's not performing well. So since we're all active, only do ETFs, our lifeblood is outperformance. That's what we spend all day on. And when you do that, then it's pretty easy to sell it to your clients. And that's the way we get evaluated by our clients. And so that's why I do a little bit of marketing, but mostly focus with our research team on beating the indices.
Yeah, I'll add to that. So when the question that I think we're getting is more around, what do these ETFs do for my portfolio? We've set out with our energy products to be kind of first to market as quick as we can, and being less focused. We obviously want them to perform well, but until there's a number of other products that are competing, performance was really less of a conversation and more around, okay, is this a diversified income source for my clients? Where does it go in my portfolio? And having that type of dialogue was really the question from clients. But then, with our webs products, it's really, how does this work, and how are you managing to realize vol, and what will that potentially do to that for my clients, and how is it different than Spire QQQ, and that it's really basic conversations and really trying to get educated with that. But I think we have found that clients are really saying, what does this do for me, and how can it help me, and spend time with those types of dialogues.
Yeah, and I think the education has shifted a bit, as I mentioned, a little bit less on the structural side and more, I talked about the proliferation of active ETFs, and like now you're having conversations specifically about the strategy, maybe how that is different than another firm strategy that's brought to market. Like Jeppy was brought up earlier, earlier this year we launched a ticker TCAL that's managed by David Drew and team that, is different in the approach in terms of how we're using options and generating premium income. So now it's more kind of where we wanted the conversation to get to, is basically talking about the capabilities of T. Rowe Price and the products, the validity of the products that we bring to market, and how those products are ultimately performing in market, and how to think about use in your portfolio.
Great. So we have a few minutes left. I wanted to open it up to any questions that we would have in the audience for the four gentlemen up here.
Sorry. Great conversation on ETFs. So wondering about, should I be in a mutual fund versus this new product that's available? I'm also wondering about a lot of issuance of ETFs in the past few years and the closures of certain ETFs because there's no adherence from the market. So just wondering, how are you planning to launch ETFs when there's so many closing, and is there something you're not going to go into? I guess don't include the leverage ETFs in this conversation, but yeah, there's a lot of things that closed, and just worried about going into something that doesn't have a track record and then having to explain to my client that it's not going to be there next year.
I'll take the sort of first part of your question. Look, the mutual fund is still a great wrapper, right? It serves its purpose. I think directionally where we're headed is that you're going to find mutual funds are going to still be very prominent in the 401k and DC space, because the record keepers are not really allowing ETFs to be part of that ecosystem as of yet, right? So sort of this divergence to institutionalize DC for mutual funds, and for intermediary retail, it's going to go ETF direction, right? And you see that with the ETF as a share class conversations that are going on, and I think over time that's kind of where there's going to be some divergence, right? And from a product standpoint, our goal is to have a very good ETF in product development. We want to be early market, probably try to set the market if there is still space. But with all these new products coming out to every day, coupled with the pending ETF as a share class, every single manager in this that's in mutual fund business is also going to become an ETF manager. So you need to get out early with really good product, and set a playbook where you're building volume, you're building assets, and so that you can be recognized for something and be around for a while.
I just add quickly on the issue of potentially closing an ETF. We treat all of our ETFs like our children, so you don't kill them off. So you just nurture them, you invest in them, spend money on marketing, buy them with your own funds, which I do a ton of. So all of our ETFs will be around as long as we're in business, which should be forever. So we don't do that. We don't close unprofitable ETFs.
We take a slightly different approach to range management. We think it's healthy. Every year we look at our lineup and determine if there are funds that need to be closed. Every ETF in the marketplace, almost every ETF in the marketplace, has to have a lead market maker or a designated liquidity provider. Each ticker requires balance sheet from those firms. So, we work collectively with the sell side to make sure we're offering the best lineup. And if there are funds that should be closed, we take a serious look at those and close them when we need to.
Yeah, I agree. I think range management certainly happens on the mutual fund side, just with the sheer number of products, and having a distribution plan is critical. So we put a lot of thought, effort into kind of not only the product design and thinking about capacity and where this is going to resonate with clients, but there's a non-zero chance that over time, as you build out a broad product suite, that not every product, you're not going to bat 1,000, right? So Then it's about like how do you thoughtfully engage with clients, and you want to make sure you give products enough time in market clearly, right? You don't want to launch something and then a year later this didn't work out, we're going to close it. Like we're thinking about our ETF business as a marathon. This isn't a sprint. So but as we're continually building out our capabilities, enhancing our marketing, increasing again just broad awareness, we have high degree of confidence in the product suite that we have and that we intend to continue to launch. But on the flip side, we want to be responsible. And as Matt mentions, there's a broader ecosystem of players out there that are supporting your products, and you want to be thoughtful about that as well.
And from the broker-dealer standpoint, we're always thankful for that thoughtfulness. And now I have a new term to think of ETFs as children, so I'll be using that. Is there any other questions for the panelists? So I'll leave it with one question just to end it off quickly. 2 years ago, when I was preparing for this panel, I wondered what else could come out. We had buffered products in the active space. We had crypto products. We had single stock levered. It seemed like there was no more innovation left. And each year, there's something new that comes out that's interesting, whether it's covered call strategies or synthetic income. There's something new every year. So we'll go down the line. What inning do you think we are in the actively managed structure, and how much more innovation can there be?
Yeah, I think we're early innings, and I won't put a number on it, but I think the fun part about asset management, and particularly this bifurcation between index and active, this is a creative side of the business. There is a lot of money to be had, and there's a lot of really great ideas to be had, and because of that, there's going to be innovation, and there are going to be things that will be coming out that aren't here today, but given the flexibility around some of the tools that are available to us to innovate and be creative, I think the opportunity is endless. I mean, I think just a quick plug on Webb's products. I think defining volatility and volatility management is cutting edge. That's that's very early days, and thinking about volatility and how to manage towards it. There's not a lot of product out there.
Yeah, I think we're still early days as well. I hear the term a lot, like ETFs is a technology, and I've never thought of them as a technology, but I think they've greatly benefited from technology, right? And I think that there's two ways to look at that. You can think about kind of the product innovation and from a strategy level, what's being delivered through the ETF structure, but then basically like what's happening around the ETF structure and how is that going to create more efficiency, thinking about blockchain and tokenization, et cetera. So I do think there's going to be a lot of changes, which is going to happen over the next kind of 2 to 5 years.
I agree with Jonathan and Tim. I think we're still very early into active ETFs, but to pivot off of strategies, something Tim mentioned. I mean, tokenization continues to come up in every conversation. So outside of looking at new strategies to launch, we're also looking at market structure changes and what things like tokenization mean to the industry.
I mean, we're much more focused on what I already mentioned, which is opportunities to outperform, because notwithstanding the launches, the market cap is still dominated by index funds, and I mentioned the areas where they're particularly vulnerable. And so that's an easy market for us to do, and we focus 100% on outperformance, and we think we're better at research than almost every other firm. So instead of trying to be super creative and launching products that might blow up like tokenization, we'd rather just be basic, be an income, and have great companies trading at reasonable multiples.
Well, that concludes our panel. I want to thank ETF Global for having us. I also want to thank Jonathan, Tim, Matt, and Jay for telling the story, and thank you all for being here.